Hey guys, thanks for tuning in. Before we get started in today's video, don't forget to join our free Facebook community, get real answers to real credit questions, learn from some of the experts in our industry, as well as from other people that are in similar situations that are taking advantage of the free content, improving their credit and making their credit situation better. Hope to see you guys on the inside.
Welcome back to the Credit Agents Talk Show. I'm Leslie, and today we're going to be talking about, is it better to pay off a loan earlier? You'll have to wait to find out. Let's talk about the pros and the cons. Pros. First of all, if you pay a loan off early, it could definitely save you money. It can also improve your credit ratio. And lastly, you can gain a lot more financial freedom by being out of debt. So let's talk about the cons. Number one, you might be penalized if you pay the loan off early, and you could have already paid off most of the loan's interest. And lastly, you could stop building credit. I think a lot of times people are afraid to pay loans off early because they want the positive trade lines. So let's get into it. I can definitely understand personally what it feels like to not want to pay a loan off early because it really is like your personal report card. Anytime you have an active loan that you're paying on time each month, this is a good thing as far as how it reports to your credit. The sooner you pay off the debt, the less interest you will pay over time. If you wanted to save money on a loan and avoid losing hundreds and sometimes even thousands of dollars, it is in your best interest to pay the loan off earlier. Here's an example. Say you borrow $20,000 to buy a car and the interest rate is only 3% and your loan term is 60 months. Over the course of the 5 years or the 60 months, you're going to lose more than $1,500 to interest. Now, if you pay it off faster, you won't lose as much. So now you see the value with paying things off earlier. You may lose the positive trade line on your credit, absolutely, but it could save you thousands of dollars. When the loan is paid off and the account is closed and in good standing, you lower your credit utilization ratio. This benefits you because once this loan is paid off and in good standing, you qualify for better rates on things like mortgages and auto loans because of the great payment history. In addition to lowering your debt, you're also eliminating the risk of maybe having another late payment or a missed payment. This is huge because sometimes if you're like me, you could possibly forget to make a payment on time, and then it's negatively affecting your credit. For example, say you took a loan out that required you to put down collateral just in case you default on a loan. That means that if you default on the loan, whatever property you put down as collateral is at risk at being taken away. Common forms of collateral can include jewelry, TVs, computers, vehicles, installment accounts, personal real estate, and so much more. While it may be super tempting to use your emergency fund or your savings account to finally pay off that loan or that credit card debt, let's talk about some of the risks and why maybe you shouldn't do that. Here is a good rule of thumb. If your finances are in good standing and you have enough money in your emergency fund to cover at least 3 months or more of living expenses, then you can go ahead and shift to aggressively paying down debt. You never know when something is going to happen, like a medical emergency, loss of employment, or a broken down vehicle. As surprising as it may be, some lenders and creditors have prepayment penalties. So in other words, while you definitely may be saving on paying the loan early in interest, is it really worth it if there is a prepayment penalty? The average prepayment penalty starts off about 2% of the outstanding balance if paid within the first year of the loan. And then they decrease with each passing year of the loan until it gets to 0. What is amortization? I hope I'm saying that right, by the way. Most loans have what's called an amortization schedule. This is going to map out how much you're going to pay in principal and interest each month. This is going to be most common when dealing with mortgages. So if you're fairly late in the loan, there's not a major advantage to paying off the loan early because generally most of the interest is paid off in the early years. Towards the end of the loan, you are basically borrowing money interest-free, so you might as well take your time when paying off that loan. Keep in mind that having a good mix of credit is essential when trying to keep a good credit score, so paying accounts off early, it could be bad. If you clear debts before they are actually due, then you could cease to have enough credit history in the eyes of the credit bureau. Now, as long as your debt isn't too high, making consistent and regular payments and bills is the best way to build strong credit. According to Jeff Aravato, a financial wellness expert at GreenPath Financial Wellness, people are spending less, which has in turn caused an increase in savings and a stronger push in paying down credit card debt, all because of a pandemic. In conclusion, I just want to encourage you that you have to do what's best for you. Only you know your goals and your financial situation. So whether your goal is to save money or lower your debt or lower your credit utilization, the choice is yours. Stay tuned for our next video where we will talk about inquiries and how to minimize the effects on the score. That's it for today. Thank you for joining us, and I'll see you next time.